When people decide to buy a home, they look at it in terms of what price range am I able to afford. But in reality, home prices are not what determines whether someone can afford a home. It's the monthly payments that actually decide whether you can afford that home. And once you understand how mortgages actually work, this becomes obvious. When a bank approves a mortgage, it doesn't care what the house costs by itself. It only really looks at one thing. Can you afford the monthly payment? Because for the bank, that monthly payment includes the principal, the interest, the property taxes, and the insurance. If that monthly payment fits within your income guidelines, the loan works, but if it doesn't, the price doesn't matter. That's why two houses at very different prices can feel more or less affordable depending on the rates. Imagine two homes. Home A costs $500,000 at a 3% mortgage rate, and home B costs $500,000 at a 7% rate. It's the same price, but two very different realities. At 3%, the monthly payment on home A might be around $2,100, and at 7%, the monthly payment on home B will be close to $3,300. That's a 50% increase on your monthly payments without the price of the home changing at all. So when people say prices need to fall to restore affordability, what they're actually saying is that monthly payments are too high, and payments are driven by rates, not just prices. And that's usually why small price drops in homes, they don't really fix affordability. Because let's say that mortgage rates rise dramatically and home prices fall 10%, that sounds meaningful. But if rates doubled at the same time that housing prices dropped, monthly payments might still be far higher than before. So even though the home is cheaper, it's less affordable. Because the pain shows up in the payment. And this is how buyers actually think. Buyers don't sit down and say, well, is this house priced fairly compared to history? What they really ask themselves is, can I afford this every single month without stressing? And if the answer to that question is yes, they'll buy. Even if the price of the house feels high, the home still feels affordable because you can manage the monthly payments. But if you can't manage those monthly payments, then buyers will walk away even if the price seems great compared to the rest of the neighborhood. And this is why housing markets often stall instead of crashing completely. Because buyers disappear because payments are too high, not just because home prices are too high. And you might be asking yourself, why don't prices fall immediately when payments spike? And this part confuses a lot of people. If monthly payments are unaffordable, why don't sellers just slash home prices? And the reason for that is because most sellers, they don't actually have to sell. They already own the home. They already locked in low mortgage rates when they bought the home, and their monthly payment didn't really change. So instead of cutting prices aggressively, they'll just wait. And what you end up getting is fewer sales, longer days your house is on the market, a lower volume on homes, but prices don't collapse. The markets will adjust through activity, not price. But monthly payments control demand way more than prices. When monthly payments are low, more buyers qualify, demand increases dramatically, and the competition of buyers rises. And that's how prices go up. But when monthly payments are high, fewer buyers qualify, demand weakens dramatically, and the competition of buyers goes down. And that's how you start to see the housing market slowing down. And notice what you're missing here. Prices don't have to move much for demand to change dramatically. The monthly payments do the work. And this is why when the Fed cuts rates, you can actually see home prices start to go back up dramatically. Because if rates fall, that means that monthly payments drop, and more buyers start to qualify to buy homes, and demand comes back quickly. And if supply is still limited, prices start to actually rise. And that's why when people are waiting for cheaper homes, they often get surprised that when rates fall, prices start to jump instead. Because the payment starts to unlock demand. And even renters have the same mindset, because renting a house versus owning is also a payment comparison. Renters will ask themselves, my rent is $2,800 a month, and if I were to purchase a home in the same area, it would be around $3,000 a month. Is that worth it? If the answer feels manageable, they'll buy. Because rent usually tends to go up over time, whereas fixed rate mortgage payments, they don't. And that stability matters more than the purchase price. Now don't get me wrong, the home price matters, especially on the day that you buy. But that monthly payment is what comes in the mail every single month. And for renters, that payment will start to rise over time. Inflation hits you a lot faster, especially when you're renting. But for homeowners with fixed rate mortgages, the payments stay the same and your wages actually tend to rise with inflation. So it actually makes the payment a lot easier over time because inflation starts to attack some of it. And that's why people who bought homes years ago often say they're so glad when they did it. Not because the price was low, but because if they were to rent the same house in the same area, it'd be much more expensive than their current mortgage. And that's when you start to see inflation come into play. Because inflation will actually raise wages, it'll raise rents, and it'll raise prices, but it does not raise fixed rate mortgages. So over time, your payment actually starts becoming cheaper in real terms because your housing cost starts to shrink relative to your income. And that's why monthly payments, not prices, determine long-term affordability. And this is also why a lot of headlines are misleading because you'll see headlines like home prices are still high. But that doesn't necessarily tell you whether people can buy homes. Because we know what really matters is rates, income, and the payment size. And two markets with the same prices can have completely different affordability depending on the monthly payments. And the real takeaway from this video is that mortgage payments matter much more than home prices because buyers qualify based on payments, not prices.